Good day to you all and welcome to Markets Today. I'm your host Mbithe. It's a Friday, the most exciting day of the week, and what makes it exciting? It's all about Ask Mbithe, a space where we talk about anything to do with shares, to do with investments, and I'm here. I call myself a financial shrink, where my work is to answer your questions in as far as looking at investments are concerned. I'm very excited to be joined by Dorka Angulu, who's joining us today for the very first time. Welcome to the show, Dorka.
Thank you, Mbithe. How are you?
I'm very well, thank you. How has your week been?
I can say it's been tough, good.
Okay.
I thank God.
All right.
Yeah.
Is COVID getting to you? Are you getting over it?
Yeah, we are trying to. We have to.
We have to.
Yeah,
we have to.
Yeah, we have to.
Okay, I think we're all looking forward to see what the president says tomorrow, June 6th, whether this is going to lift or go on.
Exactly.
All right. And you know, the thing I find interesting, Dorka, is the United States of America, most of the black people there have been out on protest.
Right.
So we haven't yet gotten a sense of whether the COVID season is over or not, because we haven't had any advance reports. So let's hope for the best. So welcome to the show, Dorka.
Thanks, Mbithe.
I'm all yours. I'm all ears. Let's hear it from you.
Okay, basically today I just want to delve into absolutely everything. Not really everything, you know, business is wide. So
okay. All right.
So today I'd like you to try and elaborate and explain what stocks are and what shares are.
Okay.
Yes.
All right. So let's start with stocks and shares. It's actually the same thing. There's no difference.
Right.
It's a term that can be used interchangeably. So you can either refer to it as a stock or as a share.
Right.
What a stock is, it's an ownership in a company. Mm-hmm. So for example, let's look at Metropole TV. Metropole TV is a registered entity. It's a limited company.
Right.
So for it to start its operations, it would typically invite a couple of people to put money together so that it can be able to run its operations. So those people who put money at the beginning, what we call equity, now become shareholders, and the company will say, maybe we'll issue 1,000 shares or 100,000 shares or 1,000,000 shares, so that people take a unit and they pay for the unit. When they pay for that unit, that's what is called a share or a stock.
Right.
Now, what happens with us, because we focus on NSE, at least on this show, these stocks or shares can either be in the private market, where, for example, Metropole TV is a privately held company, or Metropole TV can decide we want to be public, and they go and list these shares on the Nairobi Securities Exchange. When they're public, it means that you and I can buy.
Right.
When they're private, it means we don't know who the shareholders for MTV are, neither can we go and buy the shares of Metropole TV. I hope that, I don't know if that clarifies it.
Yeah.
Okay,
true.
fair enough. Thanks.
So now, let's delve now a bit on investment.
Okay.
Because shares and stocks, you just said it's one of the same thing.
Yes.
So now on investment. So if I'm an upcoming investor, and as an investment practitioner, what would you tell me to consider when I'm evaluating a prospective investment?
Okay.
Yeah.
Before you even evaluate a prospective investment, I normally take a step back and say, are you ready for investing?
Right.
You know, and there are certain things that you want to have done as an individual. The first thing is you want to be earning income, whether it's from work or it's from a business or from whatever sources that you're getting your income from, because you cannot really go and invest if you don't have a source of income. Then if you're earning your income, you want to have been able to set aside some money for an emergency fund. So an emergency fund, you can either set aside 3 months of your salary or your income, or you can even stretch it and go to 6 months. And while you're setting aside money for your emergency, is you're saying COVID has shown us that one day you could be employed and the next you could be unemployed. You want to always have money to meet your basic needs, to pay your rent, to pay school fees, to buy groceries. You know, you don't want to be out in the cold. Then once you've already done that, you're like, okay, now I am ready and I qualify for investments. Now, when you're getting into investments, it depends. You typically want to understand, who am I? Do I want a lot of risk or do I want low risk? The best way to do this is you start by investing through a money market fund or the government of Kenya bonds, treasury bonds or the T-bills. And these ones are considered a safe investment. They give you a regular return, I think now the 1-year government treasury bill is at 9.2%. So they give you a regular return. If you invest through a money market fund, it gives you access to your money anytime you want.
Right.
If you go directly to the government and say you buy a treasury bill for 1 year, you can't go and get it before the year.
No.
So you have to wait for the year to end.
So let me cut you short.
Okay.
Now, you've talked about the high risk and the low
Yes.
risk. You see, when trying to let me get that clear
Yes.
as just mtu wa kawaida.
Okay, so high risk and low risk.
Yes.
Okay, let me put it this way. High risk means you can get a high return,
Okay.
but you can also quickly lose all your money.
Right.
Low risk means the return will be low, but there's a guarantee that your money will remain. So I'll put it this way. We have hair, we bought it, it's ours, but it's like going to buy a wig or a weave. There's a place you might go downtown, you might get it cheap,
Yes.
but you don't know if it's good quality. So you might get it for 2,000, but there's the risk that it's cheap, yes,
Yes.
which is the return to you. It's not costing you too much,
Yes.
but you could get home and comb it out and it's not good quality.
Exactly.
That's what you call low risk. So it didn't cost you too much. I mean, no, that's what you call high risk,
The
because
high risk.
it's cost you some money, but the benefit it's given to you can easily be eroded away if it doesn't meet your expectations, right? Then conversely, you can go and decide, okay, me, I don't want the risk of not knowing whether this hair is good, whether it will last me for long. I will put my money aside and go buy something good that's going to cost me a bit more, but it can last longer.
Right.
So you're managing your risk. You're saying, I don't want to lose my money or to put my money and buy something that's not good. When it comes to investments, you're saying, for every shilling I put, am I open to getting a low return, which is like the government of Kenya? It's a 9.2 return you're investing in the government of Kenya. You would get a very high return. But when you go get your 100 shillings back, it will be 100 shillings plus 9.2%.
Yeah.
But then now there's another category called high risk, high return. Someone can tell you, hii 100 leta, nitakupatia 1,000 in return. You'll be very excited, you'll put your money out there, but it is very easy for that person to take your 100 and you never see it again.
That's true.
And that's what it keeps happening in Nairobi a lot. This people keep saying, we're promising you, we are going to do this and we are going to do that. So what it means when you're looking at risk, first ask yourself, am I comfortable? If this 100 goes, will I be okay? If you'll be okay, it's okay, you can risk it. If you're like, this 100 is my all be all and I'm not happy, I'm not ready to lose it, then take a lower risk, a lower return asset so that you manage. So when you're looking at risk, there's normally the element of, I as Dorka, mi nakwangaje, mi natakanga vitu, ama, then now you decide based on that. And then the second part of understanding risk is, I always say, look at the government treasury bill return as a reference rate. So if the 1 year is giving you 9.2% and someone tells you they'll give you a return for 80%, now you begin to have question marks and say, where are you getting this return from?
Yes.
That's how you sort of think about risk.
Okay.
Okay.
So my next question.
Yes.
Let's say I want to buy the stocks and shares in a company. So what is the procedure? Do I need to have an agent or an agency number, or how do you go about that?
Okay, so now you've got to the point where now you have some income that you can put aside, because shares are considered high risk.
Yes.
So it's a space where if I put this money, it could grow, it could not grow. You always have to have that mindset. So then if you're in that space, you say, okay, now I want to go trade on the Nairobi Securities Exchange.
Yes.
It's not a market like Wakulima where you just go in and collect. You have to go through the distributors, and the distributors are the stockbrokers. You see, the same way you have to go to the bank to go do your banking and to get a loan.
Yeah.
The NSC, when it's trading, it has its trading partners, and these are really your stockbrokers. I think there are about 16 stockbrokers that are licensed by the NSC. Of these 16, there are some that focus on the retail, there are some that don't focus on the retail. The same way we have the banks. We have banks that focus on the retail and the mama mboga and the SME, and then there are others that, they're just they're for businesses and for the high net worth. So it's the same way that you have with the stockbrokers.
Okay.
So these stockbrokers, what you would do is you go open an account. You go open an account with them, the same way you'd go and open a bank account. You need your ID, you need to prove your bank account details. It's just very basic, know your customer. When you open, then they give you what they call a CDSC number.
Okay.
The same way your bank gives you a bank number, you're given a CDSC number. Now with this CDSC number, you give the instruction to the broker and tell them, buy for me XYZ shares. And then you put money into their account, and then you tell them to buy. When you're buying shares, you have to buy them at a minimum lot of 100 shares. So for any stock, whether it's Safaricom, whether it's Kenya Airways, whether it's Nation Media, whichever stock, the number you always have to remember is you have to buy a minimum of 100. So it would be 100 times the price of that stock on the, of that stock on the stock exchange. And then if you want to buy additional, you always have to buy in lots of 100. So I can either buy 100, 200, 300, 1,000, 100, 1,200. That's how you keep increasing the number of lots that you're buying. Up until recently, people have been doing it manually. You go to your stockbroker's office, you fill in the forms, or they send you an account opening form. You download, you fill, you sign, you send to them. But now we've started seeing some of the stockbrokers adopting mobile banking.
Right.
I think some of the notable ones out there are Genghis. Genghis has a platform where you go download their app. It's called Jikuze. You download the app. It asks you for your basic details, and then you share like your copy of your ID and your PIN via email. You just scan on your phone and you send. And I thought that was a very it's an easier way to open accounts. Yeah. At least that's one of the most notable one. But also the other ones, the other stockbrokers also are getting into that space where they're offering that. Diane Blair, Stanbic has a brokerage group that it also operates, and it also allows for trading off your mobile phone. So most of them are going in that direction. But you know what is interesting, Dorka? Even the NSC is going into that direction. Oh, that's good. So with COVID, now we are seeing a push by the NSC saying social distancing, people cannot get to their stockbrokers. Right, How can we as a body facilitate this? True. And I think there's something that they are working around to say to Dorka, Dorka, you want to trade stocks? Here. You want information on stocks? You can do it on your NSC mobile app. So that's becoming easier in terms of getting access to the market.
Oh, okay.
Yes.
So still on shares and stocks.
Okay.
Would you say this is the right time to buy shares, if that is, in your opinion?
I like to say that everything could be a yes or a no, because it really just depends on where you're at. I look at this.
I'm saying this because as in when you look at the situation that you are in right now with the COVID-19 pandemic. So is it the right time?
Okay.
Will you be like investing, or your money will just go like that?
Okay. So I'll take a step back. Let me answer it and say, what are the things to look out for? I think you'd asked me this and I didn't answer it. To look out for. When you're looking at stocks, there are two things that you look out for. You look at the fundamentals.
Right.
And then you look at the technicals. I'll start with the simple one, the technicals.
The technicals.
So when we're talking about technicals, we're just looking at how has this stock been performing on the stock market? What's the price? Has the price been coming down? Has the price been going up? What has been the historical price performance? So that you're trying to understand if this price has been trading at, say, on average 16 shillings per share, why is it now at 25? Should I buy it at 25? No, because it has been trading at 16. If it's been trading at 16 and it's now trading at 12 shillings per share, you're like, okay, there could be a discount there. That's the first thing that you look out for. And then now when you're getting into the fundamentals are you asking yourself, how is this company operating? How does it make its money? And that's an important question, Dorka, because you as a shareholder, you make money from a stock in two ways. You make money from a stock when you buy low and it goes high. And the second way you make money from a stock is if they pay you a dividend.
Right.
So when you're looking at the fundamentals, you're asking, is this company able to make a profit and pay me a dividend? If not, then maybe I don't want to be in it. Then the other question you're asking, is this company in this time of COVID going to be able to return the profits it was generating prior to COVID? Because the same way you are looking to make money from a dividend and price appreciation is the same way that Mbithe is looking to make money out of those and everybody else in the market. So if the market gets the sense that this company won't make money, then you'll start seeing the price coming down, because I don't want to be in a stock that won't make money, it won't pay a dividend. The sentiment changes in terms of that stock. If the stock looks like it's going to recover after the COVID scenario and it will still continue to generate money and pay a dividend, then you see demand for that stock. So the basic way that you can actually look at what the price performance has been is you can go to the Nairobi Securities website, but the thing that I like the most is the Business Daily. When you actually buy the paper, there's a page towards the back that normally has the stock, the 1 year high, 52-week high, 52-week low. That tells you what has been the range the stock has traded for the last 1 year. Then as you move as you go, actually the next time I'll probably pull out that for the discussion. But as you look at the chart, it progresses and says there's ratios called the PE ratio, and there's a ratio called the dividend ratio. So the price earnings ratio compares how much money this company made compared to its price. If it's high, it means that that company is expensive. If the PE is high, it's expensive. If the PE is low, it's cheap. And the beauty about the data that the Business Daily puts out, it has all the stocks listed. And then it segments the stocks into banks, into telcos. So if I'm looking at the banks, I can see who has the highest PE, who has the lowest. So I can be able to get a sense of the relativity.
Right.
And then it also describes the dividend yield. The dividend yield is the return that you make if this company pays you a dividend. If a dividend yield is high, that is good for you because they're giving you much more money for every shilling that you spend investing. If it's low, you really do not want to be invested in that stock. So that's a basic way of just being able to look at the technicals and the fundamentals as you're going through to see, okay, this one makes sense, this one doesn't make sense. And then I think the final thing that you want to do after that is to try and see if there's research available. And I'll keep going back to the Jikuze platform because I have found it very beneficial, and it actually has research for free available to anybody who registers. So they have weekly they have weekly reports.
That's interesting.
If you want a company, you'll just go and this is a company I want to look at, so you can be able to look at it.
Okay.
The other stockbrokers also have, but for them it's only available to their existing trading clients, but I think over time they will begin to open. But this is one of the companies I think that has spearheaded the mobile trading and financial technology platform to be able to just address a need that you and I have in terms of access to information and access to opportunities trading the securities exchange.
Okay. So, which brings me to the next question on dividends.
Yes.
In a layman's language, what is a dividend and how are dividends calculated to give them, as in companies give their members certain percentage of dividends?
Okay.
Yeah.
Are you a member of a SACCO?
Yes.
So your SACCO pays you a dividend at the end of the year.
Yes.
So it will tell you we've paid you 10%, 11%, 12, 13. It will tell you whatever
percentage
it has given you.
Yes.
So what the SACCO will do is it will trade during the year, and its main business is taking money as deposits and giving money out as loans. Then that difference that it makes, it says we've covered our expenses, hii ndio imebaki, let's distribute to our members.
Right.
So the same thing happens when you're looking at the companies on the NSE. The company will trade and say, for example, it made a profit of 1 million. By the time it's calculating its profit, it has already covered its costs. If it had any liabilities, if it had any loans, it has paid its loans. It's paid for everything. Then it says, out of this 1 million, we want to keep maybe half of it, so for our operations next year in case of anything. But for the other $500,000, we'll distribute to all the people who have shares in our company. So that's the first thing that they do. That decision is made internally. The same way you don't have influence on the SACCO is the same way you can't decide whether the company will pay a dividend or not. The company, through the management and the board, will sit and say, what are our financial needs next year? How much do we feel that we want to give out?
Yes.
So the company will say, we want to give out 50% of our earnings. That's what they would call a dividend payout ratio. So if this company now decides to give a certain amount, you'll hear them saying we are giving 1 shilling per share, 1 dividend per share, or 2 shillings per share, or 3 shillings per share. So let's say a company gives you 3 shillings per share as a dividend,
Yes.
and its price on the stock exchange is 30 shillings. How you calculate the dividend yield, you would just easily say 3 shillings, which is the dividend that you're getting, over the price that you're paying for this stock, which is 30, to get a yield of 10%. So what you're saying is, if I buy this stock at 30 shillings, and if management keeps paying me 3 shillings every year, in 10 years, I will be able to get my 30 shillings back. That's the first thing that you're saying. And then you're saying 10% is a high return. It's a high dividend yield. So you're saying that maybe other people will also like this dividend yield and they'll come and buy this stock. So the price will move from 30 to maybe 35 or to even 40 or 50 in that same 10 years. So I'll have been able to earn with the share price going up because of the good prospects of the company, and I'm also earning every year from the company paying me a dividend. I don't know if that covers.
Yeah.
Yeah. Okay.
Because I wanted also you
Yes.
to explain to anyone out there,
Yes.
like, what are these dividends? What is a dividend?
Ni mazao.
Ni mazao.
Dividend ni mazao. Dividend ni kusema, when you're investing in a stock or anything, you're planting a seed.
Exactly.
You're saying this seed has cost me, like if it's maize, I'll go buy a pack of maize seeds. Maybe I buy them at I don't know how much they are, so let me not say. But I'll go buy a container or a bag or just a packaging of maize seeds. Alafu nikuja nichimbe, niweke, nipalilie, nifanye kila kitu. With the hope that at the end of the season, nitakuza. So that's the same thing with investments and in shares. Unasema, nimekuja nimepalilia, nimeweka shilingi yangu 30 bob hapa. I hope hii 30 bob, number 1, itanipatia mazao. Na hiyo, the way to calculate your mazao ni number 1, dividend. And then number 2, ikiongezeka bei kwa soko la hisa. Yeah.
Thank you so much,
You're
Mbithe.
welcome. All right.
Yes.
Okay. Let's take a quick break and we will be back. We would like to hear where you're watching from and what you would like to know. Our SMS line is 20146. Alternatively, you can reach out to us on our social media channels. That is Metropole TV or at Mbithe Mwema. See you after the break.